Quarter. All right, did everybody make the switch? Everybody still with me?
Sir.
Yes.
Awesome. All right, so now that we've kind of gotten a general overview of what accounting is and the purpose of it, again, financial managerial, this class is now only going to focus on the financial side. Principles 2 will focus on the managerial side. With that, the most important part of financial is at the end of the day, whatever occurs, we have to get to a point of presenting financial statements. So the goal, the financial statements, now there are in general 4 financial statements that are going to be pretty specific for, or pretty much the same for no matter what happens, unless you're a government entity. Governments have their own financial statements. We're not going to really focus on that. There's a complete different course for governmental accounting if you need a nap. So the 4 financials for financial is income statement, statement of owner's equity, balance sheet, and statement of cash. Those are pretty specific and general for each of the different companies. But depending on what type of business you are, each of those statements are going to look a little bit different. Not to the point of needing to name them differently, but just to give you a little bit of a difference. So they do want you to know the difference on the business structures. So we have sole proprietorship, partnership, and corporation. I would make this into a flashcard. Again, this information should be a definition for you. Just as if someone asked you to translate bonjour, in the back of your head when you do that automatically, you should automatically know if someone says a sole proprietorship, you're talking about an individual that doesn't necessarily have forms required. The difficulty to raise capital because, again, we're only one person. The risk of a sole proprietorship is unlimited because with a sole proprietorship, we don't make a distinction between the person and the corporation. And so everything that person is liable for everything that happens to that entity. So the liability risk here is definitely one to keep track of because that liability tends to be tied to the taxation. If we treat it as a single entity, the person and the corporation, then they're going to have unlimited liability, but they only get taxed once. The benefit of a corporation is the fact that the ownership is separated from the actual activities of the corporation. So I can go to the New York Stock Exchange, I can buy a piece of Amazon, I can buy a piece of all of these. That doesn't mean that I have any exertable control over those companies. I have a small sliver. And so because of that, I'm not going to be liable for any of those things that company does. Double taxation sounds confusing. What that means is that because of the fact that we've now separated the owners of the company versus the company itself, the government is going to tax the company itself. So we have revenue, expenses, net income. Net income gets taxed. Then that net income gets distributed to its owners. The purpose of being an owner is so you invest in order to share in its profit. So once they share that profit, you get taxed again. So again, that is the limit of what I will discuss in terms of taxes in this course. But again, just memorize this chart and you should be good to go. The reason that it goes from difficult to easy and capital is just because the more people you have, the more capital that's going to be available. The less trust that I have to put on any specific individual, the more likely I and more other people are going to contribute. All right, so finally we get into income statement. All right, so Here, again, at this point, if you see anything on any of the financial statements that we talk about, so revenue, expenses, these are repair and maintenance, but in general, make a flashcard. So these are called financial statement line items. These are what going to be pretty common from now until the point that you graduate. For those that are in business right now, you should have already heard of revenue and expenses. That's the goal of the income statement, is to get you to net income. From here on out, that's all you need to know. So, in terms of being an accountant, here are your financial statements. From here on, each class that you take in this semester, in this course, and in life, we're going back to this basic financial statement, but we're going to apply a little bit more complicated of an activity. Okay, so right now, all you have is revenue and expenses. We're going to start breaking out to specific type of expenses. We're going to start breaking out before and after tax. We're going to start discussing when is revenue actually earned, when is it not earned. We're going to make the transaction more and more complicated. But at the end of the day, everything goes back to these 4 financial statements, okay? And that's the goal, is how is this transaction impacting these financial statements? So revenue is inflow, expenses is outflow. They want to get through all of the financial statements before we talk. Here's your first formula. Again, you will never have to do any math in this course unless Excel can do it for you. I don't expect you to memorize the formulas, but I do expect you to be able to talk. And again, so if you've ever learned a foreign language, the definition of multilingual or bilingual is being able to dream in that language. So until you know what net income is in your sleep, what all of these words are in your sleep, keep working those flashcards. But net income is going to be revenue minus expenses. We're going to call that quite a few different things, and it's going to be based off of exactly what we're looking at. Right now, they're going to equate that to operating profit, but it's just profit, income. The point is net is the differences after we take those into account. Okay. Obviously, you have an income when revenue is greater than your expenses, and you have a loss whenever your expenses is greater than your revenue. So again, that's as basic as it gets, and now they're going to complicate it just a little bit more. Okay, and so now we're going to say it's not good just to say all your inflows minus all your outflows. Now we're going to separate specifically on the inflows. What is your main purpose as a business? And so your inflows associated with that main purpose is going to be considered a revenue. Anything that is outside of that main purpose, but that still generates an inflow, is going to be a gain. Expenses are going to be outflows that are designated exactly to your specific business. And then a loss is going to be anything that is still an outflow, but not necessarily to your operations. So the example that they give is a landscaping service. So if I'm a landscaping service, I go and cut my neighbor's yard. The amount of money that he gives me for cutting his yard is a revenue. The gas that I have to use to move the lawnmower, any travel expenses, maybe I get hungry, maybe I have a second person working with me, those are all key to the operations. And so those are going to be expenses. Now, if we go about purchasing buildings or anything that helps in the operations but not directly, then we go about selling those type of things. Anything that's outside of the core landscaping services, we're going to call that a gain or a loss. All right, any questions on the income statement up to this point?
Would this is more terms, but like would net income be like profit? Would that be correct, or is that something different?
As of right now, they're the same.
Okay, thank you.
Net income and profit are interchangeable. If you hear just income, income typically refers to revenue, and we say net income because it's revenue minus expenses. At this point, um, they don't call it out specifically yet, but see here, revenue minus expenses is operating profit. So this is going to be specifically for the everything that's related to the operations, and then we take gain or losses, and that gets you to net income. But again, at this point, they're not really distinguishing it with any big formulas. But usually, net income is considered everything and gets you to what's called the bottom line. Operating profit, and the key here is not the profit part, it's the operating. When you hear operating, they only want you to deal with what's the key to the business. But right now, they're not making that big of a distinction between that. The key is just all your inflows, all your outflows.
Thank
Okay.
you.
All right, so then we move into the statement of owner's equity. And so the reason that we move into here first is because you'll see that net income moves from the income statement to the statement of equity. Okay, so we can't do the statement of equity until we've done the income statement because we need to know what our net amount is. That's going to lead to, so when you talk about equity, it's all beginning plus, we're going to talk about minuses in a second, and then ending. Okay, so again, anything that Excel can do, that's the basics. Beginning plus minus ending. And that's going to be a general formula that we use throughout accounting, but it's simple. Start plus minus end. Here we're talking about equity. So we're going to, what is our starting equity balance? And in this example, it's 0. We're going to take the plus, which is the net income from our previous example. From the previous example. So whatever our net income is, this comes directly from the income statement. And then that gets you to your ending. Okay. So I said that there's going to be pluses and minuses here. In this example, there's only a plus, which is your net income. The negative is the distribution to your owners. So this is called the statement of equity. It's also referred to as the statement of retained earnings. The purpose of retained earnings is earnings that we retained. So when we look at that, the opposite of retained is giveaway. So we have our beginning balance. We have our earnings here. The next part is the distributions to the owners, which is so this is how much the company has earned this period. We're going to distribute that, and that is in the form of dividends to either the partners or the owners. And so you'll see that when we get to the dividends, you'll see that as a negative here. So you'll have beginning plus your earnings, less what was distributed to the shareholders, and that gets you to your ending. I know this is getting by pretty fast, but it's a pretty quick statement. So any questions on the owner's equity?
Is there any way the net income can be negative or it's always positive?
No, it definitely can be negative. And again, going back to your personal student situation, right now, we generally expect you as an entity to be at a net loss position. So your equity is at a loss. So net income, it could be net loss whenever your revenue is going to be less than your expenses. Any others? Okay, so again, income statement gets you to statement of equity. Statement of equity gets you to your balance sheet. So the balance sheet is as of 11/59 at the date of this report. This is what our current economic balance is for this company. And you'll see the ending equity balance here. The ending equity balance moves over, and that's going to be your owner's equity. We're about to learn about the accounting equation, but the accounting equation gets represented on the balance sheet. Balance sheet is separated based on assets, liabilities, owner's equity. So assets is everything that is the company's possession. Liabilities and equity is based off of who owns those. So, or what is owed at that point. And so you can see this flow here. The net, we calculate revenue minus expenses gets you net income. Net income gets added to beginning, less any dividends, gets you to ending. And then the ending gets moved to the balance sheet. Okay. So that's why these statements have to be done in this order. Here we go. So I don't want to talk about the balance sheet until we talk about this equation. So this is known as the accounting equation. Write this down, memorize it. Everything goes back to this point. Okay. When I talk about the fact that debits equals credits, that accounting makes sense because everything's there, it's because we have an equation here. And if we have an equation, I have 8 years worth of algebra that I can use in order to figure out the one piece of information that I might be missing. Okay. So if I have everything else, I can figure out that one piece that's missing. Okay. The reason why this equation is here, and the only reason that you need to, that accounting exists, is because assets is everything that is in the possession of the company. Okay. So when you think of an asset, and it's going to be a little bit different than what you've thought of if you're not used to talking this language. But when you think of an asset, the assets is your cash, accounts receivable, fixed assets, your property, your plants, your land, anything that is of future value to the company. And that's going to be equal. Think of, if that's everything that's in the circle, then it has to be either the owner's, unless there's an obligation to someone else first. Okay, so so the asset is a future benefit, the liability is a future obligation. So at some point, I'm going to have to either give a service, give monetary value, give one of my assets up. I'm going to have to give it to someone else in order to validate this obligation. And if we have algebra here, so I can take assets and then put assets minus liabilities equals owner's equity. And another way, that means that the owner, what is mine, what my investment is worth in this corporation, is going to be everything that exists within that corporation, less what I pay off through future obligations. Okay, so this gets kind of down into the bankruptcy type of concept, but the question is, if the company sold everything that it owned today, paid off everybody that it paid off, equity is going to be what that person takes home after it's all said and done. Okay. Again, this is very important for anything else you learn in accounting. So any questions on this part? When you're making the flashcards of your definitions, one of the characteristics that you need to make on every single flashcard is which category does it go into? So I expect you to define cash and cash equivalents, because again, cash is not what you have in your wallet. cash on a financial statement is different. I expect you to define investments, PP&E, all of those. Every time you define anything, ask yourself, is it an asset, is it a liability, or is it an equity? Where in this equation does it play a part? Then ask yourself, which financial statement does it show up on? Okay, that needs to be on every flashcard you have, because you'll notice none of them show up except for net income. But net income we know isn't a trial balance, it's just a calculation. The ending equity shows up here and here, but because it's changed, okay, we've changed it in order to get to this point, okay? And then the assets and liabilities. So every account that you come across is going to be one of these three statements. And so when you're making your flashcards, when you're learning how to talk accounting in your sleep, be able to distinguish exactly, is it an asset, liability, or equity? And what statement does it show up on? Okay, and then you just ask me, well, revenue doesn't show up on here, which is it? Okay, revenue and expenses and dividends we treat as part of equity, because when it comes into this equation, everything in accounting goes into this equation. The way revenue and expenses are is they go into this part, because owner's equity is the sum of every year's retained earnings. Retained earnings is the sum of every year's net income minus dividends. Net income is the sum of every year's revenue and expenses. So you can see your calculus here, but it's the sum of every year going through. So that's why revenue, we call, it is part of equity. Expenses, we call that a contra equity account, which is just fancy to say expenses reduces your equity. Think about it. Every time we make a sale, the total value of the sale increased my company, my circle's overall equity position. But usually sales cost something. I either had to pay a sales rep or I had to pay if I'm selling a product. So at the same time I bought inventory for that item, that's an expense. The expense reduced that revenue, but the net still increased my equity. Okay, I know very high concepts, but if you don't get these, the four financial statements, the three right now, I'll talk about cash flow and this equation, then we're not going to have a good semester. So does everybody understand this part?
Yes.
Yes.
Alrighty. So then I'll go back to the cash flow real quick. So a cash flow, in order to know why the cash flow is important, I first have to tell you the difference in accounting methods, okay? In financial accounting, everything that we talk about is going to be the accrual-based accounting. And I say everything, it's going to be modified. There's certain times where that won't be the case, but the other option is the cash base. So no, the accrual-based accounting is the only accepted part of GAAP. If you file financial statements, it has to be under the accrual base. Tax and managerial accounting will use the cash basis because, again, tax is very special purpose. It's based off of what politicians need for that year. And your managerial is going to be based off of just what the managers, and that will probably have a say based off of their cash flow. So they're allowed to use the cash basis. It's there. We will only use the accrual basis when we talk about financial. And the difference is, at the end of the day, and given a long period of time, there won't be a difference. But the question is, because cash trades hands oftentimes at different times than when the actual economic event occurred. Okay. And so what that means is nowadays, if I put in an order for Amazon today, Amazon's going to take the money out of my account. And then 3 days from now, I'm going to get the inventory. Okay. The economic event didn't occur until I received the goods, but the cash event occurred today. Okay. So there's a lag between when the cash trades hands and when the actual physical economic event occurred. We are only going to record the transaction when the economic event occurs. We're going to ignore, not necessarily ignore, but it's not going to be impacted in the P&L until the cash trades hands, okay? And so to account for that, we're going to have to make an accrual. Or so if I tell you, if we shake hands and make a deal, and an economic event occurs today, I'm going to record that transaction. It's either going to be a receivable or payable, depending on what side I am of that transaction. And then when I trade the cash, I'll then just offset my assets and liabilities. Okay. So this is a good example to kind of go through the differences here. But let's say we had a sale for cash. In that moment, because the sale is for cash, the transaction and the cash are trading at the same exact time. No difference. But if it's on account, that means, I mean, what it on account means, hey, I'll pay you later. There's still an economic event, so we're going to record that sale here on our accrual. Cash will ignore that transaction until they come back and pay you. Okay. So does that make sense?
Yes.
All right. So because of that, 3 financial statements that we've said, this is all based off of the accrual method of accounting. And then the question is, well, cash is king. There's no denying that. If I don't have cash, I can't operate my day to day. So we move into the statement of cash flows. And the statement of cash flows, did they not actually show one? Sorry, there's no example of a cash flow, so you're not going to get too far into that. The statement of cash flows is changing from the accrual method to the cash flow method, to where these are how the inflows go. And it doesn't look like we're going to get into the direct or indirect method on that for now anyways. Because that's right, there's a whole chapter on it, sorry. Still learning a new text. Okay, so when we look at, so this is going back to the balance sheet side of things. On the balance sheet, we like to break up, and actually, I think this is a good stopping point because those are the key areas. So Thursday's class, we'll finish up the slides that we don't talk about today. The first 15 minutes are going to be the quiz. And then from there, I'm going to open up some of the examples that are in the textbook and go through that. So at this point, any questions, concerns? Was this a decent pace? Again, it's hard without seeing y'all in person. But are y'all starting to get what I mean about accounting as a language? And are you equipped at this point to go home and start learning that language?
Is the quiz going to be like over the definitions, or like how are you going to do it?
It's going to be something I pick up from the textbook. In the first few chapters, that is going to be generally definitions or some true or false, because we're not really in the nuts and bolts yet. But that doesn't mean that there won't be certain problems. But the promise is that whatever I give you, you will only need 15 minutes. It's not necessarily a test of your mathematical prowess or your use in Excel. It's just a test of, did you read the chapter?
Okay, thank you.
Sorry, go ahead.
Over chapter 1 and 2, right?
Yes, chapters 1 and 2. Anything in chapters 1 and 2 is up for grabs.
Will this quiz be on Blackboard or will it be on a screen on Zoom?
Yeah, so good question. So because of the way that this is designed, and I hadn't had anybody tell me that they need special consideration, what will happen is there will be an assignment that I open on Blackboard. It'll be available from 11:05 to 11:20. I will give you the questions in this Zoom call. And actually, just to avoid any technical difficulties, I'll probably just put those quizzes in Blackboard. But I will sign on to Blackboard at 11 o'clock, but the assignment won't be available until those first 15 minutes after class starts, and then it will close. So you'll have only those 15 minutes to enter it into Blackboard. When we get into in person, the video won't start until after the 15-minute quiz. In each class, there'll be a 15-minute part at the beginning. You'll bring a piece of paper. I'll put the questions up on the PowerPoint, and then you'll have to answer them at that point. For those remote learning, you'll have it'll be the same as today or on Thursday, where you'll have the 15 minutes window only during that time. And the questions will be in that session.
So for Thursday, we should come into here and then open up Blackboard and then come back over here.
I'll be here, but your priority for those 15 minutes is to get into Blackboard.
Okay, so we can just exit and come back. Okay, thank you.
We're using the slides as our book, or how? Like that's how that's gonna work.
No, you need to go to OpenStax. So the slides here, which I've attached into Blackboard, is the highlight reel of the chapter, but there are more detailed definitions, analysis, examples, things that Rice University thought were more important. So the full chapter is available at OpenStax. And go to last week's presentation to find the syllabus to find the links to that.
Okay, so on Thursday at 11, when class starts, we should be on Blackboard looking for our quiz, correct? And then we get on the Zoom call?
Yeah, just because of technical difficulties, it'll be 11:05 to 11:20 will be the time that assignment's available.
Okay.
And you'll see that in the assignment 2 drop down, or week 2 of the contents. And then once you're finished, come on in here. Okay. Any other questions? And again, we'll Thursday finish up the slides. I'll pick out a few examples from the textbook to walk through so you can see presenting some of these at this basic level. And then it'll be more open-ended. Feel free to ask questions and whatever you didn't get to today. Okay. All right, well, I'll stick around for a few more minutes. Just let me know if you need anything. I'm gonna go ahead and turn the video and the share screen off.